Now, most disposals so far have been arm's length transactions where we've just sold to an individual and we've just got some proceeds which we're assuming a market value. But what if we gift an asset or sell something for less than its full value? So it might say the market value is 10 grand and you've let them have it for 2,000. Well, normally if you're selling something cheap or you're gifting it completely free, it would be with a connected person. And in tax terms, this is what we class as being a connected person. Now, the only way that we treat this differently is that if you're in this situation, the proceeds are treated at market value, and therefore you ignore the actual proceeds. So the taxman wants you to work out the gain based on what you would have received. So proceeds are what the asset's worth, and then you deduct your cost to work out your gain. So if it said, for example, market value is 10 and I sell it for 2, then you're going to put 10 in your calculation. All right, you're going to use the market value, not the actual proceeds. All right, so it's only if it's a connected party. So again, if you see a question with, you know, parents or children, grandchildren, grandparents, that sort of question, then think of that. There are other situations other than direct relatives, which we've got down here, business relationships, but the most common situation would be with connected parties. Inherited assets also give us a problem. If you inherit something in a will, then you're going to get something for free because somebody's going to leave it in their estate. So what happens when somebody dies, if they've got any assets of value, the estate gets valued, and then you're given, you know, whatever items that you receive, and you will be told what their probate value is. So you get the items for free. If you keep them, there will be no tax to pay. But if you decide to sell them and it's a chargeable asset, then you might have to pay capital gains tax. So you would then compare your proceeds with your cost. Now, in reality, your cost is 0 because you've had these for free. But what we're allowed to deduct is the probate value. So when you know what that probate value is, you can deduct it before you work out your gain. So it's a good thing to have, because if you didn't have it, then you would deduct nothing, and therefore you'd be taxed on all of the proceeds rather than truly what the assets gained in value. So that's another little one that you might see. And the final sort of odd thing to worry about is transfers between married couples and civil partners. Remember, they are taxed as separate individuals. They do get their own annual exemption, which they can't transfer to each other. And if they transfer anything between each other in terms of assets, neither person will get gain or loss. So if you've got your two partners here and they transfer anything across to each other on paper, you know, it could be transferring the house or some shares or an investment property, they will just transfer at cost. All right, so no CGT will arise. And we've got a summary here of the differences between spouses and other connected parties. But the main thing to remember is, if it's a normal family member, proceeds of market value, take off your cost. If it's a spouse or a civil partner, then, oop, jumped all over the place there, then there will be no tax to pay at all. Pull it all back. All right, so that's just a little summary there. So let's just do one more example, quite straightforward. And it's with David, who bought an asset for 150 and he transfers it to his wife. So we need to look at what's going to happen to David and Dora. So David doesn't get any proceeds, but he does have a cost. So he gave it to his wife. So it's basically a gift. He transferred it in name and he bought it for 150. But he doesn't have any proceeds. Now, David will not pay any tax, so there's no gain, no loss. So proceeds are effectively deemed to be cost, so they're just netted off. Now, Dora gets an asset. The asset costs nothing to her, but David's cost will pass to Dora. as if they were one person for this purpose. If she keeps that asset, she won't have to pay any tax either. But if she sells it, as she does here, she will pay tax on her gain. So she sells it for 400 and her CGT will be based on a gain of 250,000. So the main thing is the person that transfers in the relationship pays no tax. The receiving person only pays tax when it's transferred out of the relationship, so to an outside body. Now, if we link this to what we just did on the previous page, let's say David sells it to his sister, all right, rather than Dora, who is his wife, all right. And let's say he sells to his sister for this 400,000. Okay. Now, David will get no proceeds. All right. If he gives it to his sister, he's got no proceeds, but his sister's now going to sell it on for sister's going to sell it on for 400,000. So rather than the wife selling it for 400, the sister is. So David gifts it to his sister. He hasn't got any proceeds, but he has got a cost. Now, what he can't do is he can't do what he did here with Dora. He can't have a nil gain, because what we said on the previous page is that if we're dealing with connected parties, which his sister would be, we have to treat the proceeds as market value. So we're going to take the market value for the sister. And that is also given in the question. It says he gave it to his wife when it was worth 350. So let's assume this is what it's worth when he gave it to his sister. Yeah, so that's relative there. So even though he gives it to his sister, he has to use that market value. So he's not made any money out of this, but he is going to get tax on 200,000. The sister receives it for nothing, but her cost is deemed to be that market value. So when she sells it for 400,000, she will have a gain of 50,000. So in the first scenario, David pays no tax. All of the tax is on the person getting the money at the end. Whereas with the other connected party, apart from husband and wife, most of the tax is on David, who chose to give it away free when it was worth a lot. And then there's a little bit on the sister. But what I want you to appreciate is that overall, the tax for both of them is going to be the same, all right, in terms of the chargeable gain, I suppose, not the tax. So the amount that's taxed in the first scenario is 250, but it's all on the wife. Second scenario, we can see how it's split. So it's still taxing 250,000. Now, what you can do to practice what we've been doing here are these illustrations. So there's some homework questions here you can have a go of. You can also have a look at some of these practice questions. So there's a couple of practice questions there. And then what I will do is I will do a debrief in the last recording for Laura. All right, so you just have to have a look at the answers online for Moodle for the first few. They're fairly straightforward, but I will do you an exam debrief on this one because it's an exam style question.